All right, let's talk about something that is basically an economist's worst nightmare. It's this strange, scary place in the economy where all the usual rules just break, where the people who are supposed to be in control suddenly find themselves completely powerless. It's a scenario known as the liquidity trap.
So picture this, right? The economy is tanking, it's in a total free fall, and the central bank, they go to pull their biggest lever, their emergency brake, slashing interest rates to get things going again. But what happens when they pull that lever? And nothing. The handle is just limp. The engine of monetary policy has completely stalled out. The entire economy is just stuck. That's it. That's the trap. Okay, so let's really break this down. In normal times, right, cheap money is supposed to encourage all of us to spend and invest. But in a liquidity trap, the fear is just overwhelming. Even when you can borrow money for practically nothing, people don't bite. They just hoard cash. So the central bank is desperately pushing all this money into the economy, but it's like pouring water into sand. It just disappears into people's savings accounts and does absolutely nothing. So you gotta be wondering, how on earth does an entire economy get backed into a corner like this? Well, it all starts with one simple, hard number. A floor that the usual tools just can't break through. And that floor is 0%. Yep, zero. Think about it. Nominal interest rates can't really go negative. Why? Because you always have another option. You can just hold physical cash. Your cash has a 0% return, right? If a bank tried to charge you, say, negative 1% interest on your savings, what would you do? You'd go to the ATM, pull all your money out, and stick it in a safe at home. It's that simple. And that's what creates what economists call the zero lower bound. It's the end of the road for conventional policy. But here's where the trap gets really nasty. Check this out. Even if the official interest rate is zero, things can get worse if people start expecting prices to fall. That's called deflation. So let's say everyone expects prices to drop by 2% next year. If you take out a loan today at 0%, the money you pay back in a year will actually be worth more than the money you borrowed. So your real interest rate is actually positive 2%. It makes borrowing feel expensive even when it's supposed to be free. This is a huge deal. It doesn't just discourage spending, it actively punishes it. And that's how you get a really dangerous downward spiral.
And this whole situation leads us to one of the most counterintuitive ideas in all of economics. It's called the paradox of thrift. Now think about this for a second. If you're worried about the economy, what's the smartest, most responsible thing for you to do personally? Save your money, right? Of course. But here's the paradox. When everybody does the same smart thing at the same time, it's a total disaster for the economy as a whole. Total demand just collapses, businesses go under, people lose their jobs, and the recession gets way, way worse. In the end, everyone is poorer, even the people who are trying to be responsible savers.
This brings us to a really powerful concept known as a balance sheet recession. So just imagine you're a company, and you've just barely survived a massive market crash. You are drowning in debt. Your only thought day and night is survival. Now the bank comes to you and says, hey, we'll give you a loan for 0 interest. What do? You say no thank you, because your one and only priority is paying down the debt you already have, not taking on new risks, no matter how cheap it is. And that's the core of the problem. The central bank can make money free, but it can't force anyone to actually borrow it. Now, this isn't just some abstract theory from a textbook. This is a real-life horror story that one country lived through for the better part of a generation. To really understand what a liquidity trap looks like in the wild, we've got to talk about Japan. Just take a look at this timeline. It really shows Japan's epic struggle. It all starts in the early 90s, when their enormous asset bubble just pops. It leaves the country with what they called zombie banks, banks that were basically broke but were being kept on life support. Then, by the late 90s, the Bank of Japan had already cut interest rates all the way to 0, and the economy just flatlined. So in 2001, they had to invent something completely new, something radical, quantitative easing, or QE. Fast forward to 2013, and a new strategy called Abenomics takes that QE idea and cranks it up to 11, to a scale that was just unimaginable. And the crazy part? For decades, nothing seemed to work. The trap just wouldn't let go. So Japan's multi-decade struggle, it was a massive wake-up call for every other major economy. Because when the 2008 global financial crisis slammed into the world, central bankers everywhere looked to Japan and realized their old playbook was useless. They were going to have to invent a whole new arsenal of unconventional and, frankly, pretty strange economic weapons.
There's this classic quote from the economist John Maynard Keynes that just perfectly sums up the problem. He said that in this situation, the central bank is pushing on a string. Think about that. You can push a string all day long, but you can't make the other end move forward. It's a feeling of total powerlessness. And it was exactly that feeling that forced them to get creative and invent these brand new policies.
So what on earth is this thing called quantitative easing anyway? How does it actually work? Well, you can think of it as a three-part plan. First up is signaling. This is the central bank basically shouting from the rooftops, "Hey everyone, we promise we are going to keep interest rates super low for a very, very long time." Second, there's portfolio rebalancing. The central bank starts buying up tons of super safe assets like government bonds. This basically forces investors to take their cash and find something else to do with it. Hopefully something riskier and more productive, like investing in the stock market or funding new companies. And third, it's a huge liquidity injection. It's about flooding the financial system with cash to make sure the whole thing doesn't just grind to a halt. And believe me, the experiments did not stop with QE. Central bankers started using something called forward guidance, where they'd make these really explicit promises about future policy, basically trying to guide the economy with just their words. And then things got really weird, especially in Europe. They actually tried negative interest rates. I'm not kidding. They were literally charging commercial banks to park their money in a desperate attempt to force them to lend it out instead.
Okay, so if all these unconventional, kind of bizarre monetary weapons aren't a guaranteed fix, is there a way out? Is there some kind of master key that can actually unlock this trap for good?
Well, it turns out the answer isn't another monetary tool at all. The solution lies in a completely different playbook. We're talking about fiscal policy, the stuff that's handled by governments, not central banks.
And here's the absolute key difference. Monetary policy, the central bank stuff, it's all indirect. It's trying to nudge people and businesses to borrow and spend. But as we've seen, in a liquidity trap, that connection is completely broken. Fiscal policy, on the other hand, is direct. The government can literally just create demand by spending money straight into the economy. Think building bridges, sending out checks, or cutting taxes. It completely bypasses the broken financial system and creates economic activity out of thin air.
All right, so it sounds like we have an escape plan. But, and this is a big but, using these incredibly powerful tools isn't free. There's a price to pay. We have to talk about the side effects and the very real risks we create for the future when we use them.
Look, you just can't pump the global economy full of nearly free money for a decade and not expect some consequences. For one, you get what's called moral hazard. These super low rates can actually encourage really risky behavior, and just like in Japan, they can keep bailing zombie companies alive when they should probably go bust. Second, all that new cash has to find a home, and it often flows into assets like stocks and real estate, inflating huge bubbles that don't help the real economy much. And maybe the biggest challenge of all, figuring out how to turn off the money spigot later on without triggering a massive market crash.
So, after all that, what is the number one lesson here? Well, the consensus today is pretty clear. If you want to beat a liquidity trap, you have to act early, you have to act big, and you have to coordinate. You can't just rely on the central bank. It has to be a massive combined effort, the central bank and the government working hand in hand to deliver a shock to the system that's big enough to break that cycle of pessimism.
The liquidity trap, it's not some dusty old theory in a book anymore. We've seen it in the real world, and we know how dangerous it can be. We've forged new weapons to fight it, but those weapons have their own dangers. So it really leaves us with the final big question. Have we actually learned enough to stop the next one from happening? And maybe more importantly, when the next crisis hits, will we have the political will to do what needs to be done?